Why on earth would a country's central bank spend billions of dollars to buy up, well, more dollars? It seems a little strange, right? Like they're trying to weaken their own currency on purpose. Well, it turns out that's exactly what's happening, and it's a very deliberate strategy. Today, we're going to break down exactly why the Bank of Israel does this. So, you've probably seen the headlines or heard the news. The Bank of Israel is buying up huge amounts of US dollars. But this is way more than just a simple financial transaction. It's a really calculated economic move, and it sends ripples across the entire country's economy. So let's get right into the mechanics of how and why this all works. To really get this, we have to see this policy for what it is, an active intervention. You see it right there in the Hebrew title on the slide. Normally, Israel's currency market just does its thing, floating freely based on all sorts of economic forces. But every now and then, the central bank decides to step into the ring and deliberately influence the outcome. And trust me, this isn't just a tiny little nudge, it's a major play. And this is definitely not a new thing or a one-time event. For years now, buying up foreign currency has been one of the Bank of Israel's main tools for steering the economy. To really see the big picture, we have to understand exactly how this tool works its magic. Okay, so at its heart, this whole thing boils down to the most basic concept in economics, supply and demand. The price of a currency, what we call its exchange rate, or shar ha'halifin in Hebrew, it works just like the price of, well, anything else. It's all about how many people want to buy it versus how many people want to sell it. This slide here lays it all out perfectly. On the left, you've got the before picture. A free market. Supply and demand meet in the middle, and boom, you get an exchange rate, let's call it E. But then, on the right, the Bank of Israel steps in. It becomes this massive new buyer, basically throwing its weight around. This artificially jacks up the total demand for dollars, and that changes the whole equation. It kicks off a super simple three-step chain reaction. First, the bank buys dollars, a lot of them. Second, because of that, the overall demand for dollars shoots up. And the result? Step 3, basic economics takes over. When demand is higher than supply, the price goes up. In this case, the price of $1, paid for in shekels, rises. Now, this whole process has a technical name, devaluation, or pashut in Hebrew. It can feel a little backwards, but when the exchange rate rises, it actually means it takes more shekels to buy $1. So the shekel has effectively gotten weaker or been devalued. And believe it or not, this is exactly what the bank wants. So why would a central bank deliberately want a weaker currency? The answer, in one word, exporters. As the Hebrew on the slide says, the goal is to help them. We're talking about everyone from cutting-edge high-tech companies to farmers selling produce, any Israeli business that sells its goods and services on the global market. Here's exactly how it helps them. Let's put some numbers on it. Imagine an Israeli tech company sells some software to an American client for $1 million. If the exchange rate is, say, 3.5 shekels to the dollar, they bring in 3.5 million shekels. But if the bank's intervention pushes that rate up to 3.7, that very same sale now brings in 3.7 million shekels. That's an extra 200,000 shekels of pure profit without lifting a finger. So, the number one goal is crystal clear. It's to directly pump up the profits of Israeli exporters. Every single dollar they earn overseas is suddenly worth more when they bring it back home. This gives them a huge advantage. But the story doesn't stop there. The single action triggers a much wider chain reaction across the economy. Right, so this intervention doesn't just help exporters in their own little bubble. Oh no, it sets off this cascade of effects, like a line of dominoes, right across the entire domestic economy. And this is a chain reaction the Bank of Israel is counting on. Let's follow the dominoes, starting with jobs. So when exporters are more profitable, what do? They're encouraged to sell more stuff abroad. To keep up with that new demand, they need to expand their operations, and that means hiring more people. As these companies hire, the national employment rate goes up and the unemployment rate goes down. It's a really powerful, positive feedback loop. But there's another side to this coin, imports. See, a weaker shekel means that foreign goods get more expensive. That laptop from China or that car from Germany, it now costs you more shekels. This gives local Israeli producers a huge leg up. All of a sudden, their homegrown products are more competitively priced, which is great for protecting and growing local industries. So we've seen how this one policy affects exporters, jobs, and imports. It's a lot of moving parts. So now let's put all those pieces together and look at the complete four-part strategy that's really going on here. You see, this one policy is designed to hit four different targets all at once. First, boost the profits of exporters. Second, shield local producers from tough foreign competition. Third, push down unemployment by encouraging companies to hire. And fourth, make imports a little less attractive by making them more expensive. It's one single action with four big strategic goals. The really crucial point to take away from all this is that the Bank of Israel isn't just playing with numbers for fun. It's rolling out a broad economic strategy that has multiple interconnected targets. Weakening the shekel isn't the goal itself, it's the method. The ultimate goal is a stronger, more resilient domestic economy. Which, of course, brings us to a final, really critical question. We've seen how this intervention helps exporters and local businesses, but by making imports more expensive, it also drives up the cost of living for everyday people. So the real question is, where's the right balance? Who ultimately pays the price for this strategy? That's something to think about. Thanks for joining us for this explainer.